Okay. There's a case here. ULNAD company has annual sales revenue of 6 million and all sales are on 30 days credit. Although customers on average take 10 days more than this to pay. Contribution represents 60% of sales and the company currently has no bad debts. Accounts receivable are financed by an overdraft at an annual interest rate of 7%. ULNAD company plans to offer an early settlement discount of 1.5% for payment within 15 days and to extend the maximum credit offer to 60 days. The company expects that these changes will increase annual credit sales by 5% while also leading to additional incremental costs equal to 0.5% of sales revenue. The discount is expected to be taken by 30% of customers, while with the remaining customers taking an average of 60 days to pay. Evaluate whether the proposed changes in credit policy will increase the profitability of Ulnad company. Renpec company, certain other things are also there. So let's see. This is about the credit sales, the strategy which is adopted. Looks like it is a very small content. It is a 20 marks case. So um, if in the exam you get these type of questions, you should be able to answer it well. So Ulnad company has an annual sales of 6 million. The first one talks about evaluate whether the proposed changes in credit policy will increase the profitability of Ulnad company. So, but what is their um, present credit policy? What is the proposed credit policy? These two things have to be looked into. Now they are having an annual sales of 6 million and all sales are on 30 days credit. Okay. So there's a credit period of 30 days which is extended. All the customers on average take another 10 days more to pay this. So company is giving 30 days credit, but the customers are taking another 10 days. So altogether it comes out, it works out to be as 40 days. Fine. At present, the company is offering them a credit period of 30 days. The technicalities when we look into that, then another 10 days more time is taken for them to pay the credit period. The next part of it is contribution represents 60% of sales and the company currently has no bad debts. No bad debts. At present, they have no bad debts. Accounts receivable are financed by an overdraft at an annual interest rate of 7%. Okay. Now they are planning to offer an early settlement discount of 1.5% for payment within 15 days and extend the maximum credit to 30 days. At present, how much is it? 30 days. Now they want to extend it to 60 days. Okay. Then they also are offering a early settlement discount of 1.5% if they pay within 15 days. Fine. The company expects that these changes will increase credit sales by 5%. So their sales would increase by 5%. That is what is uh, estimated. While also leading to additional incremental costs equal to 0.5% of sales revenue. While also leading to additional incremental costs equal to 0.5% of sales revenue. The discount is expected to be taken by 30% of customers, while with the remaining customers taking an average of 60 days to pay. So these are the terms what we are looking at. So the credit sales will increase by 5%, then additional incremental cost will increase while also leading to additional incremental cost equal to 0.5% of sales revenue. Discount is expected to taken by 30% of the customers. So 60 days is the credit period, but 30% of them will pay within 15 days. The rest of the 70% will avail this 60 days facility. With the remaining customers on average of 60 days to pay. Very carefully, we now have to evaluate what is the profitability. The profitability part of it has to be calculated. What is the contribution percentage which is mentioned? Contribution represents 60% of sales and the company currently has no bad debts. Shall we start? So we'll start with the EBIT. We need to know what is the accounts receivable period. What is accounts receivable period? How many days are the companies offering? 30 days, but we also have observed that the customers are paying 10 days late, so altogether they are taking 40 days. What are their sales? Their sales are 6 million. Okay, sales are 6 million. So now, if sales are 6 million and the credit period is 40 days, a year has 365 days. So we need to find out what is accounts receivable, because annual sales are is equal to 6 million. We need to find out what are accounts receivable. Accounts receivable is equal to, how do we calculate? In a year, there are 365 days. For 365 days, the sales made are 6 million. For the credit period of 40 days, how much would be that?
Sales upon turnover.
Sales is 6 million into 40 divided by 365. The logic is, for a 365 days, the sales is 6 million. For 40 days, how much is the accounts receivable? Because the accounts receivable is for 40 days period. So for 40 days, how much is it? So that's the logic. 6 million into 40 by 365. So how much is that? Done. Then the proposed change. So the proposed credit policy. The accounts period, accounts receivable period, here it is little, what we need to understand here is, technically they are giving 60 days credit period, but um, some of them, 30% of them are availing that early settlement discount of if paid within 15 days. So 30% of them pay within 15 days. So for 30% of the total customers, credit period is only 15 days. The rest of 70% of the customers, the credit period is 60 days. So we need to find out that what is the average number of days of credit availed by the customer. So we have to find out what is the collection period, the accounts receivable period, because it's not uniformly 60 days for all of them. Some of them are availing a credit period of only 15 days. Some of them are availing a credit period of 60 days. So on an average, what is the collection period? Okay, or accounts receivable period. So let's take accounts receivable period is equal to, for some of them it is only 15 days. How many of them? 30%. 30% of the customers it's only 15 days plus, then the rest of them, for them it is 60 days into 70%. 70% of them take this much. Okay. So we got it as 46.5 days. Okay. After that, we need to know proposed sales or new sales. Why? Sales would be changing. Is that what is mentioned? So if they sell, if they extend the credit period to 60 days, they are anticipating that the annual credit sales will increase by 5%. There will be an increase in the annual credit sales by 5%. 5% or 0.15 we can write it as. 6.3 million. So 6.3 million is the new amount of sales. Then we got the new proposed accounts receivable period. Then we got what is the new amount of sales. Then we need to find out what is the new accounts receivable. So we have the credit period, the old one and the new one. We have the annual sales, the old one and the new one. Then now we have to find out what is the accounts receivable. The old one is there, so we need to find out what is the new accounts receivable. So now find out what is the new accounts receivable. Accounts receivable. How would we calculate that? The sales are 6.3 into the credit period is 46.5 divided by 365. I already told you what is the logic. So apply the logic and then use it. We see 6.3 into 46.5 divided by 365. If they adopt the new policy, what are we actually looking at? We are looking at what is the impact of the new credit policy on the overall profitability? That is what we have to focus. Evaluate whether the proposed changes in credit policy will increase the profitability of ULNAD company. So profitability, whether it increases or not, is what has to be looked into. So we just know now how much is the new accounts receivable. Old accounts receivable, new accounts receivable is what we know. But where is that profitability part of it? So we need to first now work out about what is the amount of profitability, or how is it getting affected. This increase in sales of 5% is also resulting in an increase in cost to 0.5% of sales revenue. So there are incremental costs. Fine. There is a increase in sales that we have seen, 6.3, and then increase in accounts receivable is also seen, 0.657. From that it has increased to 0.802. There is an increase in sales, so that we have observed. Increase in sales is what we have observed. Okay, then if there is an increase in sales, that is resulting in additional incremental cost is one thing. So what are the costs which are increasing is what we need to focus now. There is a benefit. Earlier their credit sales were, their accounts receivable are basically credit sales. The credit sales were only 657.534. Okay. Now the credit sales are increased to 802,603. That is the increase. The difference will be increase in credit sales. Done. If the credit sales are increasing, the point says that it is resulting in an additional incremental cost equal to 0.5% of sales revenue. So one type of cost which is increasing, benefit is increase in credit sales. Done. The cost which is increasing is additional incremental cost. So if they are talking about additional incremental cost, apart from this, there is some other cost which is increasing. Done. Then do we see anything else increasing from this set of information? Then we'll go to the next part of it. The discount, we'll discuss it afterwards. The next line is discount is expected to be taken by 30% of the customers. So but before that, is there anything from the first paragraph that we need to focus on?
Ma'am, interest that we pay on the overdraft.
That's right. From the first paragraph, we see that accounts receivable are financed by an overdraft at an annual interest rate of 7%. If the accounts receivable are increasing, we have already observed that accounts receivable credit sales are increasing. So these accounts receivable are financed at an interest rate of 7%. So cost of financing accounts receivable. So how do we calculate that one? That is, we see that 0.802603 minus, we have it as 0.657534 cost of financing into the percentage is 7%. Then we also have cost of incremental cost, no? So incremental cost. How are they calculated? Incremental costs are given as 0.5% of sales revenue. So how much is the sales revenue? The total sales revenue is given as 6.3 million. 6.3 million into 0.5%, which will be okay. This is the incremental cost. Now let's see the next part of the cost. The discount is expected to be taken by 30% of customers, while the remaining customers take an average of 60 days to pay. Okay. The discount is expected to be taken by 30% of customers. 30% of customers, while the remaining customers are taking an average of 60 days to pay. So 30% of the customers are taking the facility. So at that time, they are paying a discount of, or they are allowing a discount, or rather we put it as early settlement discount of 1.5%. So the customers are expected to pay 1.5% less than what they would be paying. So from the total accounts receivable, 30% of them are paying less amount. How much less? They are paying only 98.5%. They are paying 1.5% less. Fine. So the cost of discount. So let's put that's an additional cost. So we'll see what is cost of discount. Are all the customers utilizing? No, only out of 6.3 million, only 30% of them are availing this discount. How much discount are they availing? They are availing a discount of 1.5%. Okay. So this would be 6.3 into 30% into 1.5%. Add all of them. Okay. So these are all in million. This is under proposed credit policy. What is the cost under the old policy? Let's work it out that one also. What is the cost under the old policy also? If we know, then it becomes easy for us to understand whether what is the impact of the new credit policy on the overall profitability. So the old one, what are the costs which they are incurring? The old ones, okay. They have 6 million sales, no bad debts, okay. um, We do not see any cost which are given in case of the old ones. The proposed credit policy, we calculated the total cost. So this is the additional cost which is incurred in case of the new proposed. We do not see that there is anything which is given here in terms of the cost which are not there in the new policy. So apart from the old credit policy, the additional cost there is, we see this is one new cost of financing, then we see the incremental cost, then we see cost of discount, but these terms are not there that we can calculate it. Now if we are talking about the profitability, what is profitability? Profitability is the benefit minus the cost, the revenue minus the cost is profitability. What is the benefit? That is what we have to understand. What is the benefit what they are getting? The contribution part of it is already given to us. What is the contribution part of it? Contribution is given as 60%. Okay, so contribution is equal to, because these are all incremental costs, so we also have to look into what is the incremental contribution on the increased sales. How much sales are increased? Earlier they had sales of 6 million, now the sales are 6.3. So the the incremental sales are 5% of the sales, which is 6.3 minus 6 is 0.3. 0.3 million is the sales. So on 0.3 million, we have to apply that 60%. How did we get 0.3? 6.3 is the new sales. Earlier they had 6 million sales. Okay. On this, if we apply the 60% contribution margin, that is what we get the increased contribution, which is equal to 0.3 into 60%. So cost looks as 0.07, contribution looks as 1.18. So the profit is definitely there. The contribution minus the additional cost. Okay. So the overall, the impact of profitability is there is an increase in the overall profitability by 109,995. That is 0.10 million. So evaluate whether the proposed changes in credit policy will increase the profitability of ULNAD company. Yes, it increases the profitability of this company. Therefore, they should go about uh, availing this credit facility of 60 days, and also can go ahead and give an early settlement discount of 1.5% within 15 days, and they can also afford to incur additional incremental cost and additional cost of finance. So that is what is the conclusion. That is A bit, which is for 6 marks. Then comes B bit. B bit says that Renpec company, a subsidiary of ULNAD company, has set a minimum cash account balance of 7,500. The average cost to the company of making deposits or selling investments is $18 per transaction, and the standard deviation of its cash flow was 1,000 per day during the last year. The average interest rate on investment is 5.11%. Determine the spread, the upper limit, and the return point for the cash account of Renpec company using Miller ORR model, and explain the relevance of these values for the cash management of the company. 6 marks case, that is question, that is. Let's quickly go through the Miller ORR model formula. What does the Miller ORR model talk about? It says that first identify what is the minimum requirement of cash and find out what is the maximum requirement of cash. Calculate a return point, and then it says that do not allow the cash balance to fall anything below the minimum level. As soon as it falls to that minimum level, so whatever investment they have made in certain current assets, utilize them to pay, I put this one on the screen. Please look into that. This is the one. There is a minimum level of cash, there is a maximum level of cash. When it goes and touches the maximum level, whatever is the cash balance available, that they have to invest into certain current assets. Do not allow it to be there in the form of cash, but invest in some current assets, and then bring it down to the return point. But from the return point, if there is any possibility of the cash balance going below the minimum level, as soon as it touches the minimum level, they have to sell off their securities, and or if securities are not available, arrange for some finance and come back and touch the return point. Okay, to see that on an average, this is the amount of cash balance which is always maintained. So the return point is given in the equation form, which is lower limit plus one third of spread. Spread is given as with the formula 3 into 3 by 4 into transaction cost into variance of cash flows divided by interest rate, that is to the power of 1 by 3. Okay, remember this formula, and then we can apply this formula here in case of this one. So if you come to B bit, what are the things which are asked? Determine the spread. So first thing is we need to find out what is spread. Okay, spread is equal to, the formula is given for spread, which is equal to 3 into 3 by 4 3 into 3 by 4 into transaction cost into variance of cash flows, variance of cash flows. Okay, this entire thing divided by interest rate, divided by interest rate. Okay, close the bracket. This whole to the power of 1 by 3. Okay, do we know what is transaction cost? Okay, we need to know what is transaction cost. Transaction cost is given, variance of cash flows, standard deviation is given, so we can calculate what is variance. Do we know what is interest rate? Interest rate is given as 5.11%. So all the three are given. Let's put it across. Now transaction cost is equal to $18. Then we have standard deviation mentioned. Standard deviation is given as it's given as 1000. So can we find out what is variance? Variance is equal to standard deviation square. We know that. Standard deviation square to the power of 2. So that will become you're not able to see this Excel sheet. You didn't tell me. No one's following.
No, ma'am. Actually, we are side by side doing in a notebook. That's
Okay,
why.
okay. No, the message was highlighted on top of it. So then I realized that it is not seen. Only the PPT was displayed. Okay. After the standard deviation, what three items should we have? We should know what is interest rate. Interest rate is equal to 5.11% per annum. Okay. So 5.11% per annum. Calculate what is spread.
Ma'am, shouldn't we take per day interest?
Yes. Yes. This is per annum. I'm really sorry. This is per annum. So we need to calculate it as 5.11% divided by 365, which will give us per day. So spread is equal to 13,000. Is that right? 13,000. Did I calculate it correctly? 0.14% per
Yes,
day.
ma'am.
Okay. 13,756.98. So calculate the spread, the upper limit, and the return point. So now let's calculate. Okay, return point is given as lower limit plus 1/3 into spread. Okay. We see the lower limit given in the question. The minimum balance is given, lower limit. Lower limit is equal to this one. Minimum cash balance of 7,500. So lower limit is 7,500. After that, we see the question is asking us to find out determine the spread, the upper limit, and the return point for the cash account of RUPEC. Now, what is upper limit? When we look into the upper limit, that's the maximum limit. So maximum limit, what is the maximum limit is what when we look into that. Then we can calculate the minimum limit is there. We have the spread. Spread is also there. The minimum limit is there. So the upper limit would be, so over and above this minimum limit, and the spread part of it, if we add both of them, we get the upper limit. So Lower limit is 7,500 plus the spread is given 13,000 757 so which is equal to okay, that's the maximum limit. The return point is one third of the spread plus the lower limit. Upper limit is lower limit plus the total amount of spread. Okay. So that is for 6 marks. So a lot of work for 6 marks. Then we see another 8 marks is given for discuss the key factors when formulating a working capital funding policy. So what are the things which have to be focused when the working capital funding is to be taken up? So that's the theoretical answer which is for 8 marks. So financing of working capital and then the what are the key factors we have to look into that. What are the benefits, what are the um, problems with that. So here when they are looking at that, they have to focus about what are the strategies which they have in terms of financing working capital, how would they finance that, so their return part when they have to look into that, whether it is aggressive policy or conservative policy or a moderate policy has to be looked into. Then what is the benefit of adopting more amount of debt, and then problems with short term debt, what are the issues which arise if they are employing a lot of short term debt. Also those factors all have to be focused and then elaborate that the entire summary of the working capital you have to present it in this 8 marks answer. So what did you learn about working capital, what are the factors, every aspect of it, what is the cost part of it, what is the return part of it, okay, whatever you've learned, because it's already time. So you need to understand that and then thoroughly the entire chapter. If you are not aware of that, you will not be able to present it for an 8 marks answer. Okay, so I have taken you through working capital management. Short answers anyway, from time to time we finished. I've also discussed now here essay exam type of cases. Okay, these are 20 marks cases. So we have another 2 days. Maybe I will also ask for extension of one more day if needed. So one day can we can go through the theory of what are derivatives, the foreign exchange risk, the interest rate risk. We can discuss in one day. One day we will have it for cases from cost of capital and capital structure. So if needed, maybe I will extend for one more day. Okay, so that will help us to see all the questions. It's not possible for us to do in this 30 hours training, but as much as possible I have taken you through every type of question, every topic and every type of question. So the rest of the work will be there with you. You have to work out hard. Okay, for the moment, I am ending the class here. Students, those who are joining, please join on time. We are waiting, and time is getting wasted there. Fine. Whoever comes from tomorrow, if one student joins also, I will start the class because anyway the recording would be there. Okay. Good day.
Thank you, ma'am.